The Japanese financial markets experienced a turbulent start to the new year. Yields on 30-year Japanese government bonds continue to rise rapidly. They are now similar to those of their German counterparts. Market movements are violent, but ultimately reflect a normalization of inflation. In the years since Prime Minister Abe took office in 2013, the inflation rate has been below 0%. Through an expansionary monetary policy involving massive bond purchases, Abe succeeded in ending deflation and ensuring slightly positive inflation. After the outbreak of Corona, government-fueled demand met with a pandemic-induced contraction in aggregate supply, causing inflation to rise significantly. Core inflation, excluding energy and food, has now stabilized at around 1.5%, close to the target of the central bank. The normalization of inflation has allowed the central bank to raise its key interest rates from -0.1 to 0.75%. It has also reduced its huge stock of government bonds. This has also caused bond yields to rise. Most recently, yields have also risen because the new Prime Minister Takaichi has announced a significant higher budget deficit. The massive rise in bond yields naturally raises the question of whether the country can sustain its very high public debt of 210% of GDP in the long term. The currently low average interest rate on Japanese government bonds will rise gradually in the coming years due to the yield increase in the bond markets, but nominal GDP in the denominator of the public debt ratio is now rising significantly faster due to the return of inflation. Its growth rate is markedly above the average interest rate. This helps to manage Japan's high debt level, especially since the country has no net foreign debt. The Japanese bond market should continue to move in an orderly fashion. Nevertheless, higher Japanese yields are increasing the problem at the long end of other bond markets. Japanese investors are the largest investors in US government bonds, for example.